We're looking at the British pound versus the Japanese yen currency pair. Commencing a short trade. Now let's analyze the chart. Firstly, there is a distinct uptrend. Secondly, there is a dodgy candle on the chart. Hello, I'm Mary, and I'm here to assist you navigate in the world of trading. Today I've prepared an exciting video for you, as usual, so remember to hit that subscribe button to stay updated with our latest content. On my Telegram channel, I offer precise signals, and together we can collaborate to enhance your earnings. You can find the link to the Telegram channel in the description to this video. As always, I'll begin by presenting real-world examples before diving into the underlying theory, so sit back, relax, and enjoy the content. Let's evaluate how this strategy works on an actual chart. We're looking at the British pound versus the Japanese yen currency pair. I'm initiating a short trade right away. Since I'm employing a 5-minute time frame, the trade's duration will be 10 minutes, which equals 2 candles. The trade amount is set at $1,000. Commencing a short trade. Now let's analyze the chart. Firstly, there is a distinct uptrend. Clearly, the highs are ascending. Furthermore, the lows are consistently rising, signifying a well-defined uptrend. Secondly, there is a dodgy candle on the chart. This candle features lengthy wicks and an extremely small body, almost resembling a line. This is what a doji looks like, indicating a potential market reversal. If there was an existing uptrend in the market after the doji formation, I anticipate a downtrend. In essence, to identify doji, you need to be aware of the following criteria. Firstly, there must be a prevailing trend. The price should be steadily ascending or descending. The trend should be smooth, characterized by candles of the same color. Secondly, the doji candle must resemble a doji. It should possess a small body, ideally appearing as a straight line. In my case, the body resembles a slightly thicker line. This qualifies as an ideal doji. Thirdly, the wicks of the candle should be long and preferably of equal length on both sides. In our instance, they are roughly the same length both above and below. So I have a textbook doji here, basically. Additionally, a similar scenario occurred on this chart recently. Initially, there was a downtrend followed by the formation of the 2 doji candles, after which the price surged. Let's explore further. There may be more analogous situations. Avoid using this doji, it's risky. If there is no discernible trend, the doji is unlikely to function as anticipated. Therefore, if you encounter a sideways movement, don't even consider the doji. The likelihood of the market moving in the desired direction is exceedingly low. Better look for doji patterns exclusively when there is either a robust downtrend or a robust uptrend. Also keep in mind that the doji serves as an indicator of a potential trend reversal. When there is no established trend, there is nothing to reverse. We have 7 minutes remaining until the trade concludes. The trade is already progressing favorably with the price currently in profit. In essence, doji patterns bear a striking resemblance to hammer patterns, and they operate in a similar fashion to hammers. Nonetheless, there exists a subtle distinction between the doji and the hammer. The doji features a small body situated centrally within the candle, with the body being exceptionally petite. Conversely, the hammer exhibits a slightly different appearance. Allow me to illustrate it for better clarity. If we envision this candle as a hammer, its body should resemble this, with a minuscule wick on one side and elongated wick on the other, alongside an exceedingly small body. Familiarizing yourselves with the fundamental candlestick pattern is highly advantageous for binary options trading. I really recommend memorizing the key ones. Upon closer examination of the theory, this pattern exhibits a high degree of logicality. Typically, doji candles emerge at the peak of an uptrend or in proximity to a resistance line, as previously mentioned. And in an uptrend, when a candle reaches a local high near resistance and forms a doji followed by the subsequent candle descending below the doji's level, it serves as a robust signal for initiating a short trade. The same principle applies conversely. In a downtrend, if a doji materializes in close proximity to a support line, it functions as a buy signal. Confirmation of the signal occurs when the ensuing candle ascends above the upper wick level of the doji. The paramount aspect to bear in mind is the significance of these levels. Until you accumulate more experience, exclusively trade doji patterns from support and resistance levels. This method is exceedingly secure when trading this formation and results in profits approximately 95% of the time, actually. Alright, we now have 5 minutes remaining until the trade concludes. I've provided comprehensive explanations and now we simply wait its conclusion. The trade has indeed concluded profitably. Admittedly, it induced a slight sense of nervousness. This was primarily due to my tardy entry into the trade. Ideally, I should have entered immediately after the doji formation without waiting for impeccable confirmation. An entry at that level would have ensued a smoother experience. Nonetheless, the market has now reversed. The price is on a downward trajectory, theoretically allowing for the initiation of another short trade at this juncture. However, I have already elaborated on and demonstrated the nuances of doji patterns, while also securing a commendable profit. Therefore, I won't be executing any additional trades at this moment. What does a doji tell investors? In Japanese, doji means the same thing, a reference to the rarity of having the open and close price for security be exactly the same. Depending on where the open or close line falls, a doji can be described as a gravestone, long-legged, or dragonfly. Technical analysts believe that all known information about the stock is reflected in the price, which is to say the price is efficient. Still, past price performance has nothing to do with the future price performance, and the actual price of a stock may have nothing to do with its real or intrinsic value. Every candlestick pattern has 4 sets of data that help to define its shape. Based on this shape, analysts are able to make assumptions about price behavior. Each candlestick is based on an open, high, low, and close. The time period or tick interval used does not matter. The filled or hollow bar created by the candlestick pattern is called the body. The lines that extend out of the body are called shadows. A stock that closes higher than its opening will have a hollow candlestick. If the stock closes lower, the body will have a filled candlestick. One of the most important candlestick formations is called the doji. A doji, referring to both singular and plural forms, is created when the open and close per stock are virtually the same. Doji tend to look like a cross or plus sign and have a small or non-existent bodies. From an auction theory perspective, doji represents indecision on the side of both buyers and sellers. Everyone is equally matched, so the price goes nowhere. Buyers and sellers are in a standoff. Some analysts interpret this as a sign of price reversal. However, it may also be a time when buyers or sellers are gaining momentum for continuing a trend. Doji are commonly seen in periods of consolidation and can help analysts identify potential price breakouts. Thank you for your attention. I'm delighted to witness new subscriptions to the channel, which brings me great joy. As a reminder, if you wish to engage in trading alongside me, I eagerly await your subscription to my Telegram channel. The link can be found in the video description. See you next time.